Good afternoon, everybody, and welcome to this edition of Think Learning for 27 Jan. My name is Carl Cabalingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we delve into everything technical analysis, or at least, a very sound introduction to that topic for today. Obviously, it's a massive area of study for investors, so we will just try and pick off some of the basics and leave some of the more complex items to later Think Learning webinars. Before we get started today, though, very important to talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, no platform or subscription fees for fantastic reasons to make sure your next ASX share trade is with us. But hey, if you sign up before Jan 31, you will get your first 10 trades on us as well. So head to the website, download the Think Trader app and open an account with us. The agenda for today, as I said, look, a very broad and basic overview of technical analysis. We'll discuss what it is, talk about what technical indicators are out there, or at least some of them, have a look at price action, which is my favorite way of using technical analysis, and trends. That's also very important to me. And then try and give you a methodology using technical analysis that you can take away and start using quite literally immediately after this webinar on the stocks in your portfolio. Okay, so let's kick off with this discussion of what is technical analysis. And very simply, it's the study of how the price of a security changes over time. And the other kind of big area of analysis for investors is fundamental analysis. No doubt you would have heard of that. And that is more interested in the performance of the underlying business of that company. So you're going to look at profits and losses, assets versus liabilities, cash flows, etc., etc. Now, technical analysis cares zero about any of those things. We do not care what the company does. We don't care about the management. We don't care if its earnings are growing or shrinking or whatever. We just care about how the price changes over time. And the rationale for that, well, one of the rationales is that all of those fundamental mumbo-jumbo things get put in a pot, stirred around, boiled up, and investors then react to those items with their wallets, with their cash, either putting cash into the company's shares or withdrawing it from the company's shares, and that shows up in the price of the company. So many technical analysts, certainly this is the way I think, is that the fundamentals are generally represented in the technicals anyway. So it's kind of a fast-track way of investing, and it certainly, I don't think, ignores fundamentals. How the price of security and volume, there you go, and volume changes over time, because when investors get their wallets out, as I said, the amount of cash they put in or withdraw shows up in that volume, or the number of shares anyway. And then times the price, and that tells you how much cash there is. Okay, so it's price on the y-axis, volume on the y-axis as well, but on a separate scale, and then times on the x-axis. Let's look at a picture. And this is what I like about technical analysis. It's really all pictures. Human beings, we love pictures. Since we were running around chasing woolly mammoths, it's all about pattern recognition and pictures for us, whether that woolly mammoth is about to charge us down and make us extinct, or whether we're going to be able to get a shot in and take it home and put it on the barbecue for dinner. Well, when it comes to the share market, we are hunting good opportunities to buy or sell, and this for me is where it's all at. So the picture of what the company is doing, how the price, which is, as I said, on the y-axis over here, and the volume on the y-axis is changing over time, which is the x-axis over here. And very quickly now, obviously this is a very zoomed out chart, but if I was to look at it just on this bit, I'd see that there was a very nice uptrend in place, or any snapshot prior to that. If you looked at it from this bit, you might be thinking, well, okay, well, we're a bit flat. And then if you looked at it from this bit to this bit, you might say, well, there's a bit of a downtrend in place. And underlying these various trends, of course, is what investors are actually doing to the stock, and they're doing that because of the underlying fundamentals. So if you were to go back and check over this period what the earnings per share growth was for ANZ, you would probably find that earnings per share were rising. Over this period of time, they might have flattened down, or they were falling somewhat. And over this period of time, and I actually do know this is the case, that earnings were very flat, or contracting actually over this period. Okay, how can we plot the price on the chart? There are a number of methods here. The first one we'll talk about is simply the closing price of the chart, so literally the end of day closing price, you go into the ASX, you see what that is, and you plot it on your chart, again with the price on the y-axis and the time on the x-axis, and this may well be, this is Wednesday today. Well, it actually doesn't make sense because that was Australia Day, so that doesn't really count, does it? But you can imagine 27th of January, 26th, and so on and so forth. And we can link those dots with a line and get, just going back a slide here, get that chart there. So that ANZ chart was, in fact, a line chart. More useful, I think, than a line chart is the next two methodologies, of which I tend to flip between the two. They kind of tell you the same story, but there's more information in that story, because not only do we get the closing price for the day, but we also get the high, low, and opening price for the day. I'm going to switch to the candlesticks because they give us the same information, but I think we're talking about this pattern recognition in pictures and the way the human brain works, and it really likes pictures. I think candles give you way more. It's the same information. It's the same information as open, high, low, close, but I think it's represented in a more pictorial way. So we've still got our open, high, low, close, but what we're going to do when the close is above the open, we're going to make a box, and we call this box the body of the candle. And we could spend literally 10 webinars just on candlesticks, but we're going to spend a couple of minutes on it today. And then we have the bits that poke out of the body, the difference between the close and the high, and respectively the difference between the open and the low. And these are sometimes called shadows or tails. Often the tail ones are pointing down, as you could imagine, at the back of the candle. And the other candle, of course, is the filled or black candle, depending on what colours you like to use, and that's when the close is below the open. So very quickly we can see, and I actually haven't done it, I probably should have done it this time around. What we might do is flick between the two. So I've just gone to a charting application here that I like to use. It's called Amy Broker. It is one you can Google and purchase. You tend to have to be quite good with your programming and self-directed for this one. So it's not really your basic sort of entry-level one. So, and this is certainly not an advertisement for that. So it's just what I use, and it's just how I'm able to talk about things in this webinar for you. So we switch between the open, high, low, close, and straight away we get these periods of where there's lots of white candles, where the trend is very good, and then black candles tend to slow down the uptrend. So we're looking in this area here. So there's lots of white candles, black candles appear, and lo and behold, the trend tends to slow down a bit. Then the white candles start to appear, the trend picks up. Black candles tend to slow down the trend. White candles start the trend, and then too many black candles, and then we go down a bit until the white candles start to appear sort of around here, and then we're in the white candles. Black candles slow things down. It's really easy to get a quick gauge of who's in control of the market, the bulls. So you'll see lots of white candles, or the bears, are they sort of chipping away at the bulls' confidence with their black candles. Now, there are so many other ways to represent price action on the chart. Point and figure, Kagi, Renko, and what we're seeing here is the point and figure. I'm not going to go into those. I'll just mention them so that you can go and research those in your own time. But it is an absolutely fascinating subset of technical analysis. It's just basically how you represent, the daily ebb and flow of price change. Now, there are different styles of technical analysis. So we've gone over different ways to represent the price, but sitting over the top of that, there are different styles. And technical analysts tend to fall into one of these two camps, whether they're reactive. Okay, so they're basically seeing something on the chart and then reacting to that, or they're predictive. So they are using technical analysis to predict when something's going to occur. Reactive styles, I guess you could call it reactive styles. So trend following is a reactive style, and that is because it takes time for a trend to establish. It could take a few days, a few weeks, it could take a few months, depending on a short-term, medium-term, long-term trend that you're looking at for it to be observable on the chart, and therefore there's a delay between when that trend has started and you potentially getting involved in that. Pattern recognition, there's a little asterisk there because pattern recognition could be either reactive or predictive, as we'll see. But certainly if you had, for example, the price, and I'm just using stylized sort of price here, well, let's say you had a period from the past. So let's say you had a price action like this, and you had noticed from the past that this period here, because the price had done this, and you found some resistance, and we'll talk about this a little bit more later on, resistance up here, resistance up here, and often we find that previous points of resistance tend to act as support going forward. Okay, and this is today, and the question is whether that's going to be support or not. So the predictive, and if I go down I'm going to lose it, which is a shame. Okay, we'll just talk about it and then we'll go to the next slide. The predictive style of technical analysis may actually put in for example, a limit buy order down here. Let's say this level is $5 on the stock, and they may put in a limit order at $5, assuming, so predicting that the price will hit that level and then rally off that. A reactive trader using pattern recognition might say, okay, well, I'm going to wait until we get to here, and then I know that that's support, and then I can continue in this uptrend. So it's pretty subtle, but pattern recognition could be either reactive or predictive. Other methods of predictive technical analysis: Fibonacci, Elliott wave, and these are really pure sort of predictive models where we are, for example, picking a top or a bottom in the market. So not just kind of looking at areas of support or resistance, but actually trying to find the top. So for example, if you have a Fibonacci, using a Fibonacci level, and we had, say, a move from here to here, and you are then taking those 2 points and saying, well, Fibonacci suggests that you could have a high, if we think we're in a more broad downtrend, you could be looking for another short selling opportunity, potentially here at say 38% retracement, potentially at say 50% retracement, or then potentially at a 61.8% retracement, and that should be 0.2 to be exact. And you may well set, again, limit orders in those zones to sell the stock, or you could wait for potentially, I guess, a move back down before you said there was confirmation there that the selling was coming in at those levels. So I guess, look, it is really more predictive, but you could use it in a reactive way if you wanted to as well. Elliott wave is more looking at the waves within these moves and how many we've had, and there's a theory that the first and the third waves are the longest. So if that's wave one, you get a pullback. So it's 1, 2, 3, 4, and 5 tends to be the shortest, for example. And if you've seen that wave 5, there's a chance that it could be all over after that. And again, remember, this is an introduction to technical analysis, so I'm telling you what's out there and challenging you to go and learn more about these things and decide what works for your style of trading or what you want to get out of your trading. There are some that use a combination of the both, and I've already demonstrated that, where potentially we're using Fibonacci to find a level, and then we're reacting to confirmation from that level in terms of the price action. And a combination example of a combination model is the Ichimoku Kinku Hayu, which I will not go into today. That could be many Think Learning webinars just on that topic. There are also technical indicators, and these are probably the ones that you've had more contact with, because you tend to have dozens and dozens of them on your trading platform. For example, the ThinkTrade app, the wonderful ThinkTrade app, which has a fantastic charting package on it. And challenge you to go and investigate the power of that app, and you will find these indicators on there. For example, the advanced decline line, commodity channel index, moving average, convergence, divergence, rate of change, relative strength, etc., etc. In terms of the price-based ones, because there are also volume-based ones, you can see down the bottom. We'll just have a quick look at the RSI today. We can't go into all of them, but let's have a quick look at one of them, which is the relative strength index. Now, rather than go into the calculation of this, which I think there's very little value in that at all, it's more about what it does and then how to use it. I think let's have a practical session where we say, okay, this is what it does and this is how we use it. So the relative strength index, what does it do? Well, it measures, I guess it compares your up moves to your down moves over a period of time, and then sort of says, well, you're having more up moves, you're having more down moves on average. Okay, and look, for the most part, it tends to track what the underlying price is doing. So most of the time when the price is going up, it means that on average the RSI will be going up. But there are times where you have sort of consolidation periods or where the price is about to change, where the up moves, if you've been in a strong uptrend, the up moves aren't as great and some of the down moves start to creep in, they're getting bigger and bigger, and that's going to come up on the RSI. And it can create these, what we call negative or positive divergences. So I'm looking at, I'm just going to move myself down here. So we're looking at Fortescue at the moment. It's obviously a stock of interest at the moment for many investors. And we can see here that through this period, through November and December, the RSI moved up sharply and the price was just kind of going along its merry way. But that sharp move up then sort of preceded quite a strong rally in the stock. More recently, however, we can see that the RSI is heading down whilst the price continued to move up, and then we saw a bit of a downtrend there in the price, but it was kind of predicted in the RSI before it started to turn. I think Fortescue is down quite a bit today. There's another little one here where the price was kind of heading down through here, but the RSI started to turn around just before we had the bottom in the market there. So that would be an example of a positive divergence, and over here we've got an example of a negative divergence. Okay, negative predicting a fall in the price and positive predicting a potential rally. And that's just a couple of examples there. The other way we can use the RSI is overbought and oversold. So depending what level you like to use, some use 30 and 70. So 30 is oversold and 70 is overbought. Some people like to use 20 and 80. Depends on your trading style. I like to put them both on and see when we're sort of getting into those zones and areas, and then starting to look for positive and negative divergence. But this is an example where the price was quite overbought, for example. And this is an example where the price was quite oversold. And make of that what you will. The idea is to use these tools and other tools to build up a methodology by which we're going to trade, and we'll talk about that a little later on. So they're just tools for us at the moment. The on balance volume, we'll just do one of the volume ones. So we've done one of the price ones, so we'll just do one of the volume ones. I'm in the way. Let me put myself over here. So this one, it's interesting because we're not focusing on the price now, we're focusing on the volume. We're using the idea that volume, which when you times it by the price, represents the money coming into or flowing out of the stock. We're trying to see what the what investors are doing, not so much what the company's doing, but what are the investors doing that are powering these price moves. And when there's an up day, we're going to add the current days, or that up day's volume, to the ongoing on balance volume tally. And when there's a down day, we subtract it from that tally. So it's a running tally of how much volume there was on up days compared to how much volume there was on down days. So is the money going in or is the money coming out of the stock? And again, we're looking for these divergences, and I'll just because in the interest of how much we've got to get through here, I'll just point out what's going on here with Fortescue, and you can see on balance there was quite a lot of accumulation through this phase. So accumulation, and then it went really flat, actually, went really flat through here. So that's a little bit of a discrepancy to what the price is doing. So yes, the price was going up, but it wasn't going up on as much positive volume. So that would be an indicator that potentially the price might flatten out, which is what it eventually has done, and it's come down a little bit today. Okay, and you can use that for trying to find divergences the other way as well, where there's money coming in and the price hasn't really taken off yet, as to find buying points. But they are pieces of the puzzle, aren't they? Each indicator we can use is a piece of the puzzle. I'm just pointing out that there are price-based ones and also volume-based ones. Now we get to what is my favourite sub area of technical analysis, which is price action analysis. And again, we're still focusing on this concept of how the securities price changes over time, but we're going to build it up from intraday signals, for example, our bars and our candles, we've talked about those, to intraday signals like trends, which we have sort of broadly discussed, but we'll get into more detail in a second. And then pattern analysis, we've already talked about this idea of support and resistance. Previous areas of resistance tend to act as support, previous areas of support tend to act as resistance, but you can also have something like a triangle where the price has, for example, consolidated into what looks like a triangle if you were to draw the lines, and there are various theories about what could and should happen after that. And you can get the same thing on the downside, and there are descending triangles, which is this one here. There are ascending triangles, which is this one here, and they both have various sort of predictions on what can happen next. And again, this is an overview, so I challenge you to go and investigate some of these further. And then you have head and shoulders patterns where the price might be doing something like this, and literally it looks like a head. There's your head, and there's your shoulders, shoulder 1 and shoulder 2, and that is then predictive of what might happen next. And you have the inverted case of that, cup and handles, and there are dozens and dozens more. In terms of the price action, how do I use the price action? Well, I like to look at use price action to define my trends. So in the most basic sense, we have our short-term uptrends, and very simply here, we can just compare the highs of 2 periods and the lows of 2 periods, and higher highs and higher lows make a short-term uptrend, and lower lows and lower highs make a short-term downtrend. And here's the neat bit: the highest point between a short-term uptrend and a short-term, that should be D, short-term downtrend, is what we call a peak, okay? And the lowest point, and this obviously heading through here, we would have then a short-term uptrend by definition. The lowest point between a short-term downtrend and a short-term uptrend is a trough, and you would have heard this no doubt, peaks and troughs, but this is how you define what they are. And unequivocally, there can be no confusion. Either today's high is higher or lower than yesterday's high, and so on. Sometimes that can be equal, but we have rules around that too. And then we're looking for higher peaks and higher troughs. Potentially that one's a higher one, to make medium-term trends. So we've gone over the definition of a short-term trend: higher highs, higher lows, or lower highs, lower lows, respectively, for short-term uptrend and short-term downtrend. And medium-term trend, that come from the peaks and troughs. So higher peaks and higher troughs, right, make our medium-term uptrend. And when we have lower peaks and lower troughs, that makes our medium-term downtrend. And if you were to jam these two together, okay, if you were to literally squeeze those together to one bit of price action, you'd have a medium-term uptrend on this side, a medium-term downtrend on that side, and guess what? Again, we're jamming these together. This would be a single point, of course. That would be a long-term peak. And then you can build those up to find long-term troughs, and you can put 2 and 2 together, and your long-term uptrends would be a series of higher long-term peaks and long-term troughs, and long-term downtrends would be lower long-term peaks and lower long-term troughs. And from this, you can therefore classify literally every single candle or bar on your chart as being in a short-term, medium-term, or long-term uptrend. And what I like to do is find periods where they're all in alignment. So where I have a short-term uptrend plus medium-term uptrend plus long-term uptrend, and they would be, I can only consider those as buys, and I can only consider the opposite for sell, which would be the short-term downtrend, medium-term downtrend, long-term downtrend. And I'm able to create a set of rules. So I can do my analysis and create a set of rules for what I can buy and what I can sell, rather than going on guesswork and hope. Let you decide what you'd prefer to use. Okay, so why be a trend follower? Well, trend following for me is all about following the big money. We talked about on balance volume before and how we can use that to follow with what the money's doing. But if you were to have a long-term uptrend, that's where your really big money is being active. Medium-term uptrend, not as much. Short-term uptrend, they're your traders. You're not really interested so much in what they're doing. But once you have trends changing in the long term, that means big money must have come in to make that occur. you increase your probability of success. Well, I think a big part of that is you're no longer guessing, but number two, you're no longer trying to fight the trend. So we're no longer looking at a chart that's doing this and trying to figure out, where do I go short? Okay? Because if you're doing that, you're not following the trend, you're not following the money. The reason why this is going up is because demand is greater than supply. Okay, and if demand is greater than supply, you have to ask yourself, the people that are demanding, what do they know about this stock and why do they like it so much? And the flip side of that is there's very little supply. So if there's very little supply, why is that the case? Well, it's because it's a very good stock and people don't want to sell it. So we don't want to do that. That's a big no-no. And we certainly, this is what most people do, because most people tend to go long and not short. And this is, quote unquote, one of the dumbest things you can do, is looking at a chart like this and wondering, where do I buy? Okay, because once again, supply is greater than demand, and clearly there's a very good reason why people are supplying, and a very good reason why they're not demanding, and we don't want to try and find that bottom. The probability lies within trying to trade in these bits in between. Yes, eventually there will be a turning point, but the trends are about capturing the big bits in between. It's adaptable to your trading style. So if we choose short-term indicators, even the price action model I just showed you, you might just trade on the short-term trend. Or you might say, I'm going to trade on the medium-term trend, or I'm only going to trade on the longer-term trend. So it's adaptable to your trading style. And you can have two portfolios. You can have a short-term portfolio and a long-term portfolio if you wanted to. And they can have two separate sets of rules with two separate sets of cash. Opportunity to make large profits, as I said, we're trying to take the big swings in between and not worrying ourselves about the possibility or the probability that the price might change. We will get out, we'll have systems for getting out when we need to. Okay, disadvantages of trend following, it is reactive. So if you're following this wonderful trend and then it starts to make lower medium-term peaks, and let's say you got in here, okay, because that was your buy level, because there's your medium-term peak, there's your medium-term trough. I've actually told you exactly how you can define these things unequivocally without any argument or confusion. I've already shown you how you can do this. Medium-term trough. Okay, we'll call that 1, we'll call that 2, we'll call that 1. So this is your entry point for a buy. And you might say, well, actually, that's not following the rules because you only have 2 troughs and you don't have 2 peaks yet. And I would say, no, we're absolutely following the rules, because once we break above medium-term peak 1, we don't know and we don't really care where medium-term peak 2 is going to form. We know that wherever it forms, because we're above medium-term peak 1 by definition, it must be higher. So it's not even anticipating, it has to be the case. So this is actually your entry point, because this will have higher peaks, medium-term peaks, not high medium-term troughs. So if you are a medium-term trader, you'd be looking for these signals. That would be your entry point. And then literally here, where you go, and we're going to call this medium-term peak 3, medium-term trough 3. And once again, it's just the reverse. Do we have lower medium-term peaks? Yes. Do we have lower medium-term troughs? Well, I can't see the lower trough 4 yet, Carl. It doesn't matter. Wherever it forms, wherever medium-term trough forms, it's going to be lower than 3. And therefore, this has to be my exit point here, okay? Okay, so if that is my sell, where did I get in? I got in at, say, point A, and I got out at point B. Did I make money? Of course I did. Did I get the whole trend? If we call this X and Y, did I get in at X? No, I didn't. Did I get in at Y? No, I didn't. So I didn't make the whole, the total amount of profit, but I made a good chunk in between, and that's all I care about. It's about the probability. I don't want to be involved alongside if the price action is down here, because it's telling me that the dynamics of supply and demand aren't in my favour. So trend following is reactive. We didn't get the top, we didn't get the bottom. We don't care about that. I challenge anybody to consistently pick those tops and bottoms over a long period of time. It's just not going to happen. It's not a disadvantage. It's not really a disadvantage, is it? Because you need this all the time anyway. But it's important to note that you require the discipline and patience. And patience is a key thing here, because because you're reacting, you're waiting for things to happen. And in this period from Y to our exit point here, we've given up quite a bit of profit, haven't we? So this is profit that we had that by the end of the trade we no longer had. And for most people, they can't really deal with that. They can't handle it. It's not suited to their type of personality. So you need to be a very patient person to be able to say, look, I haven't got my trend signal yet to get out. So I'm going to just, yes, I can see my profits eroding, but I'm going to just be disciplined with this, because what we don't know, and let's say we had a scenario where it was going up, much like it did, and yes, we had that lower peak, and before we made the lower trough, boom, boom, how many times have you seen that before? How many times have you seen that before? So it's the patience for not getting out as we're seeing our profits eroding until we get the signal. Okay, and we didn't get the signal here, and off we go. So do you have the patience to follow this sort of a model? Now, price action is my preferred way of doing things, without a doubt. Nothing is quicker in the market than price action. So we've got a lower high and a lower low, bang, the short-term trend has changed. It will take you a few days for the RSI to catch up. It'll take you a few days for the on-balance value to catch up, because they are averages. They average out price action over a period of time. Nothing's more coincident with what is happening than price itself, and that's why it's my preferred tool when it comes to technical analysis. But it's not always easy to do. Now, I've got various models and formulas and things that I've worked on for many years, and some of my models well over a decade. If you're starting out, you need a quick and easy way to find those trends and then decide whether you're going to buy, sell, or hold. So, useful trend following indicators here. If you want to go down this trend following path, moving averages for me by far and away the best way to do it. I prefer exponential moving averages, and I'll just very quick on this. They just move faster than your simple moving averages. So on your charting package, you'll have the ability to select either simple, exponential. You can go double exponential, triple exponential if you really want to rev things up. I'd go with the plain old exponentials, but I certainly don't use the simples, because they tend to react very slowly to the price action. Again, remember, these things are dumbing down the price action. They're less responsive because they're using averages, so we want them to be less responsive, if that makes any sense. What's good about moving averages, though, we can very quickly identify the direction, the strength, and the sustainability of any trend over any time frame that we're interested in. If we want to be a short-term trader, we use shorter-term moving averages. If we want to be a longer-term trader, we use longer-term moving averages. They're unambiguous, much like the price action model I showed you, because they have a value, and you can compare those values to other values and then make decisions. And the other good thing is they're on all technical analysis platforms, so we don't have to buy a fancy platform to find these things. We'll tie everything we've talked about up to this point together in this bit here, which is the methodology. So if you're wondering, well, okay, show me something I can use, Carl. Well, this is where it comes in. What is a methodology? It's a set of rules which clearly and unambiguously, they probably didn't need both of those words, but I'm trying to make a point here, specify. So there can be absolutely no grey area when it comes to your technical model. It has to be absolutely black or white, yes or no. Is today's high higher than yesterday's high? Well, it either is or it isn't. And is there a medium peak there? Well, either it is or it isn't. And we're going to use this criteria that qualify a trading setup, qualify when we change an order. So we might have an order in the system to buy if the price breaks above the previous medium-term peak, and therefore moving us into a medium-term uptrend. Okay, and the price doesn't break through that medium-term peak. In fact, it forms a lower medium-term peak, and then a lower medium-term trough. Well, we're not going to leave that order in the system forever. So we need to have a set of rules that determines when we amend our orders. Okay, it might be amending a trailing stop loss. So, for example, if we are trading that price action model I talked about before, and we had an entry point. In fact, we could actually go here after this trough, and I challenge you to press pause if you're watching this on the recording and understand why that actually would be, the formation of that trough would be the point where we go into medium-term uptrend. Okay, so if that was our entry point here, and this is our entry point, we might say that on the formation of the next trough, which is here, so point A, we will trail our stop loss up, and let's say we set it underneath that trough, we might trail it up to point B here. Okay, and when we make this trough here, and I know these letters are all over the place, C, we might then trail our stop loss to underneath point A, and we would just keep going until eventually we got stopped out. Okay, so we have a system of rules which define how we get in, how we change orders, and how we get out as well. Okay, exiting. And most people, for me, it's very easy for them to get into a trade, like falling off a log. All of a sudden, we've got we start with some cash, and before we know it, 3 days later, we've got a portfolio. But then how do you get out? That's where they fall down. How do you get out? of your investments. And I've presented to you here a very clear-cut model on how to do that based upon ultimately supply and demand. Okay, so let me give you one you can use. I call it the 3 trends model. It's very, very simple, but very, very effective. It's purely price action based. However, look, we've got to use moving averages. We're going to use EMAs to proxy that price action, probably the best way to put it. It gives you unambiguous entry, amendment, and exit signals, and it's trend following, which means it's reactive. Let's head over here to the charts. This is where I wanted to go to actually show you how to use this thing. I'm looking at the time, we're over time, so I'm just going to be very quick on this. So what we can see here, if I go right-click parameters, you can see what I've put on. I've put on an exponential moving average 21. I've made that a red line. I've put on a moving average 126. I've made that a blue line. And I've put on a moving average 252. I've made that a green line. Now, why these particular moving averages? What is the significance of 21, 126, and 252? And this is an example of a person who I guess is probably a medium-term investor. It's certainly not a short-term model if you're using these. Now, you could make it more of a short-term model by making these averages smaller. Okay, but the averages are just averaging the price action, all of those uptrends and downtrends over a period of time. 21 periods is about a month. When you take out weekends, public holidays, your typical month has about 21 periods, and then we're just using multiples of 21. So that'd be 6 months if you do the maths, and that's about a year. So what we're looking at is the price action on average over a month, the red line, on average over 6 months, the blue line, and on average over a year for the green line. And then I've just done some little fancy coding here to give us what we call a ribbon. So we're shading the area between the red line and the green line, and we're making it green when all of the averages are pointing up. So the average price action over those periods of time. And you could go back and look at each high and low and peaks and troughs, or you can use the moving average to summarize those things over your relevant time frame. So we're saying roughly short term, about a month, roughly medium term, about 6 months, roughly long term, about a year. And these are proxies for those price action trends we talked about before. And when we have all 3 trends heading up, and when they're all in the right alignment, I say that you've got the short-term trend above the medium-term trend, which is above the long-term trend. You've got a period of time where the demand is greater than supply on average over those time frames. Okay, and you have periods where, on average, over the short-term time frame, there's a bit more supply than demand. Okay, and you get these warning periods here, and you decide whether if you're a medium-term trader, you might only get out once the price goes below the medium-term moving average. If you're a short-term trader, you might get out, once the price goes below the short-term moving average. If you're a long-term trader, you might not get out until the price goes below the long-term moving average, or those various moving averages turn down depending on the system you want to use. But long story short, we're just looking at Fortescue here, and we can look at any stock you like. We can see that the trends started to align for Fortescue back in 2019. Okay, we actually haven't had the move into downtrend since, even as we speak today. Okay, so if you're using this sort of model, you would have been a buy around $4 and you'd still be holding, waiting for signals to get out. We haven't had a pink signal yet where they're starting to go in the wrong direction. Why don't we find one that's maybe in a downtrend? I know that A2 Milk has been having a tough time of it lately. And this is a good example of showing when trends change, I guess. So we can see that we started to go here, and I think what we're finding here is that the moving averages are no longer in the right order, and therefore we're getting a signal to get out of A2 Milk. Now, did we get out at the top? No, we didn't, but we certainly got out with plenty of warning for what was potentially going to happen next. And then you could also say, well, would I buy A2 Milk now? And the answer would be no, because the trends are not lining up in the right direction. And you can see many, many examples of where the system is quite accurate. Okay, let's head back to the slides and finish this one off. As I said, it's only meant to be a very, very broad introduction, give you a taste of some of the places you can go and investigate. We do have plenty of other really interesting and insightful and educational articles in our market news section of the website. So go to market analysis, click on market news, and of course the webinar section as well, where you would have registered for this one. And you do need to register for the upcoming webinars. We do have our usual weekly think tank on Monday mornings, and then next Wednesday at this time we'll have our Ask the Experts, where you can bring your portfolio along and ask me to have a look at various technical and fundamental factors for your portfolio. And then we'll switch gears to Wednesday, 10th Feb, with 3 small cap stocks to watch in 2021, and then back to Ask the Experts, which is our fortnightly catch-up. The disclaimer before I leave you says that everything we discuss today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So before you act upon any of that general advice, please consider it carefully. Look, give us a call or consult the website for further details. It has been a pleasure being with you today. Hopefully you got lots out of it. All the best for your trading. Until we catch up again. Bye-bye for now.